Luxury storefronts don't just disappear overnight, unless something serious is happening behind the scenes. Yet across major shopping districts, Jimmy Choo is closing hundreds of stores, and the reasons behind it are far more revealing than a simple downturn. What was once a symbol of class is now part of a sweeping retail pullback that few saw coming. Behind the glamorous image, the numbers tell a sad story. Jimmy Choo is preparing to close many of its stores worldwide, shrinking a retail network that once stretched across more than 500 locations. This isn't a slow trim, it's a reset. And it's happening as luxury foot traffic has fallen by nearly 25% since 2022, while online luxury sales push past $150 billion a year. Rising rents, higher labor costs, and changing shopping habits are squeezing brands that once thrived on physical presence. But Jimmy Choo's retreat goes deeper than mall traffic. Some of its most recognizable markets are being hit first, raising questions about demand, margins, and long-term strategy. In this video, we're breaking down why Jimmy Choo is closing so many stores, what's really driving the decision, and what it signals about the future of luxury retail. This isn't just about fashion, it's about an industry being forced to change. Let's explore more details. Capri Holdings' financial struggles. Capri Holdings is the company behind some big fashion names many people recognize around the world. It owns Michael Kors, Jimmy Choo, and until very recently, it also owned Versace. To most people, these sound like glamorous brands that make beautiful clothes, shoes, and accessories. But behind that glamorous image, the company began to face serious financial troubles over the last few years. These troubles changed its plans, pushed it into hard decisions, and ultimately helped shape the story of why Jimmy Choo, one of its brands, is closing stores now. In the early 2020s, Capri Holdings looked powerful. It reached many continents, opened shops in fancy districts, and sold high-end products to shoppers in major cities like New York, London, and Tokyo. At that time, its business model was simple: sell luxury items in stores and online and grow year after year. But people around the world started spending differently. Economic uncertainty made many shoppers hold back on big purchases, and fewer people were buying luxury clothes and accessories. Slowly, Capri Holdings' sales began to shrink. By the end of its fiscal year 2025, Capri reported a net loss of more than $1.2 billion, a figure that was much larger than in the year before. This was a dramatic shift for a company that had once relied on steady profits to grow and open new stores. The main reason for this big loss was goodwill impairment, a financial term that means the value of the brands Capri once bought or built was worth much less than expected. In practical terms, this means that the company had to mark down the value of its brands on its balance sheet, which counted as a huge loss on paper. Revenue, or the money the company earned from selling products, also fell. In the fiscal year 2025, Capri's total sales were around $4.4 billion. This was a decline from previous years, and it happened even though the company had more than 1,000 retail stores operating around the world. These stores were supposed to be the lifeblood of the business, but because fewer customers were buying, they began costing more to operate than they brought in. One big part of the company's strategy was to borrow money to grow. For years, Capri took on debt to expand its stores and take over iconic fashion names like Versace. But as sales weakened, that debt became harder to manage. By the end of fiscal 2025, Capri had about $1.5 billion in cash, but also about $1.3 billion in net debt, meaning that after counting cash, it still owed a lot. Having high debt levels while revenues are falling makes it difficult for any company to invest in new ideas, open more shops, or even keep the old ones open. Capri's leadership knew this was a problem, so during 2025, the company started talking about changing direction. One of the most dramatic steps it took was selling off Versace, one of its most famous brands. In December 2025, Capri completed the sale of Versace to the Italian fashion group Prada for approximately $1.4 billion in cash. The idea was simple: raise cash to pay down debt and give the company breathing room to focus on its remaining brands. But selling a key part of the business also confirmed just how much Capri needed help. It was no longer a luxury empire. It had to focus on survival first. Without Versace, Capri is now more focused on two brands: Michael Kors and Jimmy Choo. These are still well-known labels, but they face their own challenges. Michael Kors is larger and brings in more revenue, but even it saw sales decline compared to previous years. Jimmy Choo, smaller in scale but beloved by its customers for its stylish shoes and accessories, also saw revenue drop. These trends are telling. Even established names are not immune to shifting consumer spending patterns in a changing retail environment. Capri's story is also a story of a luxury market in transition. Across the fashion industry, many brands are struggling with the same basic issues. Shoppers are being more careful with their money. Online competition is rising, and trends change faster than ever before. These problems hit Capri hard because most of its revenue used to come from physical stores and wholesale accounts, which are more expensive to run and slower to adapt than digital platforms. As a result, Capri's operating margins, the difference between revenue and the cost of running the business, have been squeezed. To give you a sense of how tough things have become, Capri's financial reports show that the company's operating margin fell into negative territory, meaning it spent more to run the business than it earned in profit. When a luxury brand makes fewer products and sells less, it can cut costs to some extent, but many costs are fixed, like store leases and staff salaries. That makes falling revenue even harder to weather without restructuring. Capri's management has tried to reassure investors that the company is working on a turnaround plan. Leaders said they expect sales trends to improve slowly over time, and that selling Versace gives them flexibility to reduce debt and reinvest. They also announced future goals for revenue growth, including a plan for Jimmy Choo to grow toward a higher revenue target over the next few years. But they have been clear that the immediate priority is stabilizing the company's finances rather than rapid expansion. What does all of this mean for Jimmy Choo? This is where the consequence lies. Reduction in retail footprint. In the world of fashion, stores are more than places to sell products. They are the heart of a brand's image. For luxury names like Jimmy Choo, a store on a busy street or high-end mall signals prestige. For many fans of the brand, seeing a Jimmy Choo boutique in their city meant that the brand was doing well and growing. But over recent years, that feeling of constant expansion has changed. Instead of adding more stores around the world, the parent company began closing stores and shrinking its retail footprint. This shift tells a powerful story about how the company is adapting to new realities. Looking at the numbers, they show change clearly. In the past, Jimmy Choo and the other brands under Capri Holdings operated a large global network of retail stores. In the fiscal year 2023, Capri reported that it had hundreds of Jimmy Choo stores, ESS, both full-price boutiques and outlet locations around the world. At that time, Jimmy Choo had more than 230 stores globally. But fast forward to recent reports, and that number is clearly smaller. By early 2025, new figures from Capri Holdings showed a reduction in the number of Jimmy Choo stores across the globe. For example, as of the 29th of March 2025, Jimmy Choo had 163 full-price stores and 56 outlet stores, compared with higher counts in previous years. Overall, the total number of retail stores at Capri had gone down to 1,158 from 1,239 the year before. This drop was part of a trend where the company was closing or not renewing leases on underperforming shops. A few months later, Capri's first quarter fiscal 2026 results showed similar patterns. As of the 28th of June 2025, Jimmy Choo's store count had slightly decreased again, with the brand operating 217 stores worldwide, down from 227 the year prior. At the same time, the total number of all Capri Holdings retail stores, including Michael Kors and Jimmy Choo, had dropped to 912 from 991 inches the prior year. By the second quarter of fiscal 2026, the trend was still clear. As of the 27th of September 2025, Jimmy Choo was operating 216 stores globally, down from 226 inches the prior year. And Capri's total store count for all brands was 907, below the 981 stores reported the year before. These ongoing changes show that the company is actively reducing its physical retail footprint, rather than maintaining the larger network it once had. When people hear store closures, they often imagine empty shop windows and leased spaces left behind. But behind those closures are strategic decisions. The fashion business has changed a lot in recent years. Fewer people are shopping in traditional malls and busy downtown streets compared with the past. Many customers now buy luxury items online, and digital shopping has become a normal part of life. That shift puts pressure on brands that once depended heavily on physical stores to sell products. Luxury brands cannot afford to keep stores open in every city if customers are not walking into them as often as before. In addition, not all stores are equal. Some locations perform very well, selling popular products and attracting many customers. But others, especially in smaller cities or lower traffic malls, may sell fewer products and cost more to maintain than they earn in sales. Under these conditions, Capri's management decided it was better to close stores that were underperforming or costing too much to operate. Closing a store may seem negative at first glance, but for a brand, it can also help improve overall profitability and allow investment where results are strongest. This approach is sometimes called right-sizing the retail fleet. Instead of having more stores everywhere, the company focuses on fewer stores in the most important markets, places where the brand is strongest, where customers are likely to spend more, and where sales per square foot are high. For example, Capri wants to concentrate on major fashion capitals or cities with strong demand for luxury goods. In these markets, a Jimmy Choo store can have high sales, justify the rent, and create a strong brand presence. Another part of the strategy involves renovating and refreshing the stores that remain open. Some stores are being upgraded to provide a high-end experience that matches customer expectations. Instead of simply reducing the number of locations, Capri wants the stores that stay open to look fresh, offer excellent service, and reflect the future vision of the brand. These renovated stores support a stronger brand image and can make customers feel excited to visit again. It's also worth noting that the closures are not always permanent eliminations of the brand's presence in an area. In some cases, Capri might move stores to better locations or combine smaller outlets into larger flagship stores that offer more products under one roof. These decisions are part of a broader effort to enhance the customer experience rather than simply reduce the number of stores. For people who love Jimmy Choo shoes and accessories, store closures may feel disappointing. It means fewer chances to walk into a neighborhood boutique, try on shoes in person, or see the latest collections up close. But when seen from the company's perspective, the changes are about survival and future growth. Underperforming retail locations cost money, and reducing them allows Capri to focus resources on its best stores, invest in digital shopping experiences, and strengthen the brands that remain. Now, let's take a look at the major factors influencing this shift. Weak consumer demand and revenue declines. If you walked into a sparkling Jimmy Choo store a few years ago, you would see shiny shoes, tall heels, elegant bags, and happy customers. People once rushed in to browse the newest collections. But over the last few years, something has changed. Not just for this brand, but for many luxury fashion houses around the world. Customers began to buy less. Shoppers became more careful with their money. And this change hit brands like Jimmy Choo hard. This part of the story is about how these trends helped push store closures. First, it's important to understand what consumer demand means. Simply put, it is how much people want to buy something. Luxury brands like Jimmy Choo depend on customers feeling confident and excited to spend money on high-end products like designer heels or signature handbags. But in recent years, that confidence has faded in many places. People around the world started spending less on luxury fashion as they felt uncertain about the economy, rising prices, and future job stability. This shift in behavior had real consequences for luxury brands. Capri Holdings reports its financial results every few months. These results show how well each brand performs and how much money it earns from sales. In the first quarter of fiscal 2025, Capri announced that Jimmy Choo's revenue dropped by about 5.5% compared to the same period the year before. This decline was driven mainly by softening demand globally for fashion luxury goods, meaning fewer people were buying high-end fashion overall. Those numbers tell a clear story. Even though Jimmy Choo was still selling products, revenue was lower than before because people were buying less. In the Americas region, revenues even increased slightly. But in other major markets like Europe, the Middle East, and Africa, EMEA, and Asia, revenue decreased significantly. In Asia alone, Jimmy Choo's sales dropped by about 17%. This region is especially important for luxury brands, because Asian customers were once among the fastest-growing buyers of fashion goods. When revenue falls, it doesn't just affect the number at the bottom of a report. It affects every part of the business, from how many products the company makes to how many people it hires, and whether it can afford to keep stores open in expensive shopping districts. That's because revenue is the engine that drives everything else. Even when revenue drops only a few percent, the impact can be large. That's because luxury fashion is a high-cost business. So when Jimmy Choo's income fell, it put pressure on the company's ability to make a profit. The third quarter results of the same fiscal year tell a similar story. In that period, Jimmy Choo's revenue fell by about 4.2% compared to the previous year. While this might look smaller than the earlier decline, it still reflects the same trend. Customers were buying less luxury fashion overall. At the same time, Jimmy Choo's operating loss widened, meaning the brand spent more than it earned in that quarter. Looking at full-year data confirms the bigger picture. In the fiscal year 2024 fourth quarter, Jimmy Choo's revenue dropped by an even larger 9.3% year-on-year. This was not a small blip. It was part of a pattern showing that demand was weaker across multiple periods. Retail sales decreased at low single-digit rates, and wholesale revenue, as sales through department stores and other partners, fell even more sharply. While the brand continued to attract new customers, as shown by growth in its global database, this increase in customer numbers did not fully translate into higher revenue. That's because many new customers may browse or sign up for newsletters, but not all of them make big purchases, especially when they are uncertain about spending on premium products. The data showed that the global database of customers grew year over year, but revenue still declined. A large part of the drop in revenue also came from softening full-price sales. Full-price sell-through refers to how much of a brand's inventory is sold at the original listed price, rather than at discounted or sale prices. Lower full-price sell-through means more products are being sold at discounts, or not sold at all, which reduces revenue and profit margins. This trend has been noticeable for many fashion brands as they try to attract cautious shoppers with promotions or markdowns. These declines were not limited to Jimmy Choo alone. Capri's overall revenue, including Michael Kors and Versace, also fell sharply. In the third quarter of fiscal 2025, total revenue decreased by more than 11%, showing that the trend was broad and not tied to any one brand. The luxury fashion business as a whole was dealing with sluggish sales. Capri's leadership acknowledged that the overall business remained challenged and said they were working to improve sales trends. Part of the reason customer demand weakened so broadly has to do with the global economy. In many countries, inflation, higher interest rates, and slower economic growth make people more hesitant to buy expensive items. Traditional wholesale partners like department stores were themselves struggling in some regions, leading to lower orders. Meanwhile, in other regions, weaker retail sales were not fully offset by online shopping gains. This mismatch contributed to lower overall revenue, even as the brand increased its digital presence. Another factor in declining demand was the shift in consumer priorities. Younger generations sometimes choose experiences over products, meaning they may spend more on travel or technology rather than luxury fashion. Others may prefer smaller, meaningful purchases or second-hand luxury items rather than full-price new products. All of these cultural shifts have played a role in weakening demand for new luxury goods, including shoes and accessories from brands like Jimmy Choo. When demand weakens, companies must respond. Lower revenue means the business cannot grow as it once did. Instead, it must find ways to operate more efficiently and survive with less income. Closing underperforming stores is a way to reduce costs when customer demand is not high enough to keep them profitable. For companies like Jimmy Choo, adapting to this new reality means making tough choices to align the business with evolving customer spending patterns, or risk being left behind. Interestingly, the parent company has mapped out strategies for a better brand future. But the question is, will it work? Let's find out. Profitability over expansion. In business, success is often measured by growth. More stores, more products, more customers. But sometimes growth can be too expensive, and companies have to change direction. For Capri Holdings, the company that owns Jimmy Choo's, Michael Kors, and until recently Versace, this moment came when profits weakened and debt increased. Leaders at Capri realized that simply having big brands was not enough. They needed a new strategy, one focused on profitability, not just expansion and market presence. This strategic shift has shaped many decisions at the company. After acquiring big names like Versace and Jimmy Choo, the company once seemed destined to grow at all costs. But by 2025, the economic environment was no longer friendly. Luxury consumers became more cautious, demand slowed, and Capri's revenues dropped. At the same time, the company had high debt levels and weak operating performance, meaning that even when it sold items, it earned less profit overall. Rating agencies took notice and downgraded Capri's credit rating, saying the company's performance pressures and high leverage made its financial outlook more uncertain. Faced with these pressures, Capri's leaders decided that the company could no longer focus mainly on expanding or keeping every brand it owned. Instead, they needed to strengthen the company's financial core. This meant taking steps to reduce debt, improve cash flow, and focus on the parts of the business that had the best chance of long-term success. In plain terms, Capri stopped trying to grow everywhere at once and began trying to make the business stronger and more profitable where it already had a presence. Capri's financial reports from 2025 and early 2026 show this shift clearly. Revenue continued to decline slightly, a sign that the global economy and consumer demand were still challenging, but costs were managed more carefully. Gross profit margins, although reduced, stayed stable enough to give the company hope. In the first quarter of fiscal 2026, Capri saw an operating margin of 2%. For a company trying to improve profitability after losses, this is a noteworthy detail. It showed that the business was becoming slightly more efficient at generating profit from sales. The company's CEO, John D. Idle, also expressed optimism about the long-term effects of these strategic moves. In public statements, he described signs of improvement in sequential performance, meaning financial metrics looked better quarter by quarter, even if they were not yet strong enough to declare a full recovery. These improvements were seen as evidence that Capri's profitability-focused plans were starting to take effect. Another element of the profitability strategy was careful allocation of cash and capital. Instead of spending large amounts on new store openings or aggressive expansion into new markets, Capri began prioritizing returning value to shareholders and strengthening existing operations. Initiatives like a substantial share repurchase program, where the company buys back its own stock, signal confidence in future performance and a focus on long-term value rather than short-term growth. This change also meant streamlining operating costs. Capri looked for ways to cut unnecessary expenses, including reducing headcount in certain areas, consolidating offices, and improving supply chain efficiency. When a company tightens its operations, it often reflects a move toward profitability. Spend less overall and spend smarter. These kinds of internal adjustments don't make big headlines, but they are crucial for improving profit margins when sales are not growing strongly. Importantly, Capri's strategic shift did not mean giving up on its brands. Rather, it meant rethinking how those brands grow and earn profit. For Jimmy Choo, this included focusing on segments that deliver higher returns, such as accessories and casual footwear, and emphasizing product lines that resonate with customers. It also meant strengthening digital channels and selecting store locations more carefully based on performance, not just prestige. These choices speak to a new generation of thinking, where profitability guides business decisions more than brand stacking or large presence. The strategy also addressed market realities. Consumer spending patterns have changed in recent years, with customers becoming more selective about luxury purchases. By adjusting product pricing, marketing, and store formats, Capri aimed to reconnect with customers in ways that support profit generation rather than simply revenue growth. These kinds of strategic adjustments reflect a business that listens to the market and adapts, rather than one that holds to old models of retail success. Looking ahead, Capri's leaders have set clear goals for returning to growth, but only after establishing strong profitability. The company expects that by focusing on financial health now, it can build a solid foundation for future expansion when the economic environment improves. This approach shows discipline. Instead of chasing growth while bleeding money, the company chose to stabilize first, grow later. Capri is positioning itself for a future where strength and sustainability matter more than size. Meanwhile, there are so many reasons why Jimmy Choo fell drastically, and they're not jokes. Broader retail sector pressures. Store closures are not limited to discount chains or middle-market brands. They are happening across the entire retail landscape, including the world of luxury fashion. In recent years, the global retail sector has faced a powerful shift, sometimes described by analysts and journalists as part of a broader retail apocalypse. This trend has added pressure on brands like Jimmy Choo and its parent company, Capri Holdings, forcing them to rethink how and where they operate. Understanding these broader pressures helps explain why store closures at Jimmy Choo are part of a much bigger story. One of the most obvious shifts is the rise of e-commerce, people shopping online instead of in physical stores. Before the pandemic, online shopping was already growing steadily. But when COVID-19 struck, that growth accelerated dramatically as millions of customers turned to digital channels for safety and convenience. Even after lockdowns ended, many shoppers continued to prefer online buying for most of their purchases. Today, e-commerce accounts for a much larger portion of total retail sales than ever before. And this has weakened foot traffic in traditional malls and shopping districts, where luxury brands like Jimmy Choo often rely on customers walking in. While online shopping is one piece of the puzzle, another major pressure comes from department stores and anchor retailers, struggling or collapsing. Department stores have historically been key partners for many luxury brands, but many of these large retailers are now in serious trouble. For example, the newly merged Saks Global has faced massive financial challenges and is reportedly preparing to file for bankruptcy due to overwhelming debt and falling sales. The problems at Saks are more than an isolated case. Major department store chains across the world are struggling to adapt to changing shopping habits. Without strong traffic and sales, these stores are reducing their orders from luxury brands or even closing flagship locations. When these big partners cut back, the impact spreads throughout the industry, including companies like Capri Holdings that depend on wholesale channels as part of their sales strategy. At the same time, economic headwinds and shifting consumer behavior have reshaped luxury retail. According to major industry reports, the global luxury market has faced real challenges in recent years. After years of growth, luxury sales, including personal goods like shoes, bags, and accessories, experienced their first significant downturn in 15 years in 2024, and forecasts point to further slowdowns into 2025. One reason for this is that the number of active luxury consumers has dropped. Reports show that global luxury shoppers declined from roughly 400 million in 2022 to around 340 million in 2025. Not only are there fewer customers, but many existing customers are prioritizing smaller purchases, experiences, or resale markets instead of full-price luxury goods. This trend has fractured spending patterns in the luxury world and added pressure on physical stores that rely on higher-value purchases. Many fashion brands also face margin pressures, meaning the profits they make from each product are shrinking. Higher operating costs, slower sales growth, and increased discounting have brought industry profit margins down to levels not seen since the 2009 financial crisis. This erosion of profitability makes it much harder for companies to justify expensive storefronts, especially in high-rent areas. Tariffs and trade policies have also played a role. Luxury companies have reported concerns that tariffs and international trade uncertainties could raise costs for imported goods, squeezing margins further and complicating long-term planning. While some companies try to shift manufacturing locations to reduce tariff impacts, these strategies take time and add operational complexity. Luxury retail today also competes with alternative spending priorities among consumers. Many shoppers, especially younger ones, now prefer spending on experiences like travel, dining, and entertainment over material goods. Annex Plus, particularly expensive fashion items. This shift reflects changing values, where brand purchases are not the only way people pursue enjoyment or status. Another pressure that has intensified is price sensitivity. After years of steep price increases in luxury goods, some consumers have begun to question the value relative to the cost. Analysts have noted that a significant percentage of luxury goods are now being sold at discounted prices, the highest rate in over a decade, as brands try to move inventory and attract buyers. This trend not only hits margins but also changes how customers perceive the exclusivity of luxury brands, sometimes weakening their appeal in core markets. Worse still, for many retailers, the decline in middle-class spending on aspirational luxury has intensified these pressures. A once growing group of middle-income shoppers, those who would occasionally buy lower-priced luxury goods, has pulled back significantly due to overall financial stress and rising living costs. As these customers reduce their discretionary spending, luxury brands lose an important segment of their consumer base, further weakening sales at physical stores. The shift toward resale and second-hand luxury markets has also cut into traditional store sales. Many consumers who still want luxury items, but at lower prices, are turning to resale platforms, which offer authenticated pre-owned goods at reduced prices. While this channel can keep brand names in circulation, it does not directly benefit the original brand's retail sales and can reduce full-price demand. All of these broad retail pressures combine into a powerful cross-current, pushing stores to reevaluate their worth. This environment has forced many retail brands to reduce their physical footprint and rethink where and how they engage customers. For a luxury brand like Jimmy Choo, which once benefited from global store expansion, these pressures have reshaped long-term planning and accelerated store closures that were once unthinkable. If this breakdown changed how you think about luxury, let us know in the comments. Do you think Jimmy Choo has any chances of rising back up to the way it was before? Drop your thoughts below. Hit that like button, subscribe, so you never miss our next deep dive into the hidden dynamics of wealth, status, and the brands desperately trying to capture both. Because in luxury, nothing is permanent.